Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about SoFi Technologies and Palantir Technologies. In this video, we will be analyzing 3 articles, to where the first one is titled SoFi Technologies Q1 Earnings, the Red Flags. So we'll be discussing the various problems with SoFi Technologies and why their share price still has not found a bottom and has not rebounded yet. After that, we will discuss 2 other reasons for a total of 3 reasons of why SoFi stock is trading in the red lately and whether or not we can anticipate a rebound in the future. We will be analyzing the bearish thesis for this company because I have so many positive videos on this company. I want to make you aware of the other side of the argument so you can make an informed investment decision. Lastly, we'll talk about Palantir Technologies PLTR stock, where it's headed in the future, and the various predictions and forecasts that professionals have submitted regarding their upcoming earnings report on May 8th. So for more videos just like this one on Palantir Technologies and SoFi Technologies, go ahead and annihilate that like button right now, smash it, go ahead, press it right now, subscribe if you are new, don't forget to become a member of this channel by pressing that join button right next to the subscribe button to support me personally for literally just 99 cents. So if you enjoy these types of videos and you want me to make more, don't forget to go and become a member, and without further ado, let's jump right into today's stories. As you already know, SoFi Technologies is a fintech company or a neobank that essentially operates as a digitalized bank, to where they give their consumers an all-in-one inclusive digital app where they get access to various financial services and products at the tips of their fingers. Recently, as you are aware, they brought in phenomenal results regarding their earnings per share and revenues in their most recent earnings report. However, despite this, their share price has absolutely plummeted, and now it looks like the share price is consolidating, which is pretty positive because in the future, it's just a matter of time before we experience a rebound. However, what is artificially suppressing the share price right now? Well, I'm glad you asked, so let's dive into the bear thesis surrounding this company. The main problem and the number one risk for SoFi Technologies right now, which is directly related to their share price dropping, is their AFS portfolio, and that would be their available for sales portfolio regarding their loans, to where SoFi Technologies AFS portfolio currently consists of approximately 10 billion unsecured personal loans, which is adding some volatility and risk to SoFi's overall bullish thesis. So let's talk about why this is so bad, or is it truly that bad? Right now, if you didn't know, SoFi Technologies uses a third party to evaluate and mark their available for sale loans every single quarter. And this is somewhat of an unusual practice because normally banks do this themselves and they value their assets internally as opposed to hiring or using a third party. However, that's not necessarily the reason why this is so risky. However, I personally have nothing negative to say about SoFi's third party valuation because their valuation takes into consideration various input data points, average coupon, default rates, spreads, and many other factors. So overall, I'm not here to talk about or diss their third-party valuation firm that they are currently utilizing. However, I'm talking about the AFS personal loans themselves. And here is where we find the main problem of SoFi taking on a lot of risk that some investors are not willing to take on or add to their overall portfolio. Normally, SoFi originates these loans, but there's an expectation for SoFi to hold the loans for between 6 to 9 months and then sell these loans, which lowers their overall risk, especially if any of these loans go into default, because they're getting a lot of revenue and interest income from these loans for around 6 to 9 months, and then they are offloading these loans and selling them to other financial institutions, to where if the people that the loans were given to default, that would be that bank's problem, not SoFi's, because SoFi already sold the loan. However, as of late, it seems that SoFi has tended to hold on to their loans longer than expected, and this would mean that SoFi has had a growing loan problem of piling up unsecured personal loans. And this could add a lot of risk to SoFi, because if a recession were to happen and people default on their loans, SoFi would be the one floating the bill for this, and that's why investors are not necessarily so excited because they found this out after the earnings report. And this is the main thing that is causing the SoFi share price to drop, and that's why we haven't seen a rebound yet, because SoFi has not fixed this problem. Now, I tend to look at it from a different perspective, because SoFi, by keeping these loans longer, they are receiving a lot of net interest income. For instance, the contribution of these loans from their lending segment have grown from around $87 million to $210 million per quarter. And this is predominantly due to the net interest income on high-yielding unsecured personal loans. So this is actually, in the meantime, giving SoFi a lot of money. But what were to happen if the economy gets worse and we enter into an even greater recession? How would this impact SoFi Technologies? Well, essentially, it would be catastrophic. The unsecured personal lending space does deliver fantastic return on equity throughout many different economic cycles except a recession, because that's when these loans could go into default, to where SoFi Technologies would be stuck with loans that people are not willing to pay. And right now, there are no reserves on SoFi's balance sheet that are set to buffer any of these potential losses if that were to happen. However, I do want to snap back a little bit, saying that SoFi's portfolio overall is still very strong, to where their average member has a FICO score above 747, and a credit score of 747 or above is pretty positive, meaning that these people are very unlikely to default on their loans even during a recession. I've also said in previous videos how many of SoFi's members are young high earners making well over six figures or $100,000, so clearly they are in a position to pay back their loans even if the economy goes down the drain somewhat. The author of this article reiterates that SoFi is not in a very good position, considering that they do not generate GAAP net income or profitability, meaning that they really wouldn't be able to absorb any of these losses impacting their unsecured personal loans if they were to go into default. And since SoFi Technologies is not selling these loans as of right now because the market's not very hot, SoFi will actually grow this overall portfolio of unsecured loans, making them riskier and riskier. However, this does give them the opportunity to continuously scale their overall revenues higher, because they are going to make revenue off of these loans for a longer period of time. Essentially, I think once the economy starts to bounce back, SoFi will be selling these loans and lowering their overall exposure to unsecured personal loans. But if that doesn't happen, and this bubble just keeps getting bigger and bigger to where their unsecured personal loan portfolio grows and grows, eventually, yes, they are taking on a lot of unnecessary risk. And even though it's positively impacting their revenues, if a really negative recession happens, SoFi could technically go underwater if all of these people default, or the majority of these people default on their personal loans. Other than that, though, SoFi Technologies overall is very resilient, and I do like how they are positioned, because this is not only a risk for SoFi Technologies, this is a risk for the majority of financial institutions which have unsecured personal loans. So it's not like SoFi is the only one suffering from this. A lot of financial institutions are at risk of this right now. However, in the meantime, they are making a lot of net interest income from these loans. The second reason why SoFi's price is consolidating right now, which currently trades for $4.68, even though by the end of the year many experts believe this company should at minimum be worth around $7, is because their guidance wasn't raised enough for the full year. Now, let me comment on this, because I think that's a terrible reason to sell the overall stock. SoFi is already growing extremely rapidly, over a 30% CAGR, much quicker than the majority of other companies on the stock market. So to say that since they brought in better than expected revenues and earnings, and they adjusted their full year estimates to an even greater number, somehow that justifies someone selling their shares, that makes no sense. If anything, they are even better off now than they were, because they have increased their overall guidance, which should be looked as positive. Although the guidance increase wasn't extremely impressive, because they increased their guidance from $2 billion of revenue up to $2.02 billion, and they increased their EBITDA from 280 to 288, I still think these are positive developments, because even if they didn't increase their yearly guidance, SoFi is still growing extremely rapidly. So I don't think that's a very good point that some bears are pointing out. Lastly, I do think there is another problem regarding their Galileo accounts. Galileo essentially offers back-end payment infrastructure technology, and it enables many companies to provide digital banking and card issuing capabilities. And for the first time time since Galileo was acquired by SoFi Technologies, the Galileo accounts fell from 131 million down to 126 million during the first quarter. However, the CEO of SoFi attributed this decrease in their overall Galileo accounts with the decision to stop going after small accounts and focus more on larger accounts who are going to be more durable clients even during times of volatility. Now, Galileo, I do anticipate, will eventually rebound once the economy recovers. So depending on whether you think a recession will occur, how bad the recession will be, or other factors regarding your portfolio, you should use them to make an informed decision on SoFi Technologies. But overall, SoFi Technologies had an amazing quarter, brought in phenomenal revenues and earnings. They're growing extremely rapidly, and they're set to be GAAP profitable by the end of the year. So I think there are far more bullish, positive catalysts coming up than there are negative catalysts. But until SoFi Technologies can give investors some peace of mind over their ever-growing unsecured personal loan portfolio, then the share price will continue to consolidate between $4 and $5, even though the year-end price target goes as high as $7, which is very positive. People are going to make a lot of money from this company as long as you are willing to take on this risk. And for me personally, I only have a 4% portfolio allocation to SoFi Technologies, and if the share price drops even lower, I will increase my allocation to a 5% allocation, but I will not go above that because that would be improper risk management. And comment down below your thoughts, because I really enjoy giving you both sides of a company, the bearish positive news as well as the bearish negative news, because together that information will allow you to make an informed investment decision. Lastly, let's talk about Palantir Technologies, ticker symbol PLTR, which is a big data and analytics company which serves both commercial enterprises as well as government clients. Palantir Technologies is in the news today because they are rapidly approaching their earnings report, which will be on May 8th. Over the last year, the PLTR share price has fallen by around 34%. But despite that, investors are still somewhat positive. Right now, investors are concerned about their earnings per share and revenue that they will bring in on May 8th. As it stands, Palantir's management will hold an earnings call after market closes on Monday, May 8th. Right now, analysts are forecasting and projecting that the company will bring in around $505.9 million worth of revenue for that quarter. And if analysts are right, that would equate to a 13.3% increase overall, at least compared to the same quarter in the prior year. Management, on the other hand, has revenue projections that range between 503 to 507, meaning that analysts probably are dead on with this, considering that 505 is right in the middle of 503 and 507 million. And I do think they will meet or exceed this expectation. However, I'm really hoping Palantir not only will beat in revenues, but also beat on their overall EPS. For revenues, I think they will either bring in exactly or very close to what was predicted, or end up having a revenues beat. But even if that were to happen, that is not necessarily going to move the share price, because investors right now are more intrigued with their overall earnings per share. There were also a lot of great catalysts that happened with Palantir Technologies that I think were somewhat overlooked. For instance, management stated that in early April, Palantir Technologies struck a deal with Microsoft, ticker symbol MSFT, which is a great company to own. I own loads of Microsoft, so that Palantir will be allowed to expand the cloud partnership between the two firms to include government agencies. On top of that, the Department of State selected Palantir Technologies to modernize the data management for the Bureau of Medical Services, and these are very positive catalysts that I just think were overlooked by investors, even though right now, yes, I do believe Palantir is overpriced, but depending on how long you want to hold this company, they should grow into their overall valuation and exceed that valuation, thus returning value to you as a shareholder and investor. But now let's talk about their earnings per share. On their EPS side, the company is set to generate a net loss of 1 cent per share. And although that doesn't seem great because the net loss can be looked at negative, that would be a huge improvement compared to the 5 cent per share net loss that they experienced 1 year earlier. So this means that they are having huge improvements regarding their overall EPS. However, on an adjusted basis, they should bring in a profit per share of 4 cents. And this is really what we want to hone in on. If they beat on their overall earnings per share on an adjusted basis, this will be very positive. However, if they don't and they miss, clearly we could anticipate that the share price will actually tumble down. And beyond that, there were no further guidance, at least regarding their earnings per share, that management gave, because again, these are analyst estimates. regarding their earnings per share. Now, why do I like this company if I believe they are overvalued and I'm not sold on their overall earnings report? Well, the reason I like the company is twofold. One, the company virtually has no debt, and for a growth company, that is extremely uncommon. Secondly, they are currently carrying around $2.66 billion worth of cash or cash equivalents, meaning that we could directly subtract that from their overall market cap regarding their value, making this company much more digestible in their overall current share price. Especially if operating cash flow is positive like it was last year, you can expect this number to continue to grow, putting Palantir in a very fundamentally stable position even if a full-on economic recession occurs. On top of that, considering that they have a lot of government agencies, which they get a lot of business from, Palantir is actually set to shine during these negative macroeconomic environments. Now, for the full year, management did say that they are anticipating the company to bring in between $2.18 billion and $2.23 billion, which should represent a 15.7% growth rate. Although this is not ideal, still a 15.7% CAGR is pretty positive for Palantir Technologies right now. It's clearly not as bullish as their past or prior CAGRs, but I do think that is overall pretty positive. So even if we take a conservative estimate of the midpoint forecasts and projections and estimates from management and analysts, we can see that overall, the company is in a fair position right now. The main takeaway is that investors are worried about Palantir's overall EPS approaching this upcoming earnings report, and honestly, we don't know what to expect from this. However, whatever comes in will dictate Palantir's future growth trajectory over the next 3 months, which is why I personally have a hold rating on Palantir Technologies, at least for now. So I'd love to hear your thoughts down below about both Palantir Technologies and SoFi Technologies. Don't forget to become a member of this channel to support me personally for as little as 99 cents. It helps me out so much, and I want to give a huge shout out to all of my existing members. Thank you so much. You make these videos possible. Don't forget to subscribe if you are new, smash that like button if you haven't already, and I will see you in the next YT video.